Hi, everybody. Nice to be speaking up here again. Again, Alan Shayanfekr, co-founder and CEO of Sharestates.com. We are a marketplace lending platform specifically focused on real estate debt, where we connect individual accredited investors and institutional investors with sponsors and developers, real estate sponsors and developers looking for financing on their projects. I'm going to just start quickly with a little background information, a little bit more in depth than I spoke about before. My two co-founders actually got started in the real estate industry back in 2001 as principal investors, developers themselves, doing all types of projects from residential fix and flips to some ground-up condo construction, multifamily buy and holds, everything in between. And having gone through that process a number of times, they actually realized that there was a pretty lucrative but painful process in the title insurance industry. So in 2003, they actually started their own title insurance company with a heavy emphasis on catering to speculators and developers because that's the industry that they understood. That's where they came from. So for those of you who aren't familiar with title insurance, it's probably one of the most difficult industries to grow in because everybody has a relationship. They've got an uncle, a cousin, a grandmother, somebody who has a relationship that they drive their business through. And ultimately, your ability to grow in that industry is dependent on relationships and auxiliary services that you could provide. So in catering to these speculators and developers, they would do everything from hosting networking events to helping their clients negotiate complex transactions and ultimately helping their clients syndicate debt and equity opportunities, really, without monetizing it, but more so for brand development. So fast forward to 2012, I actually had joined up with my partners, Raymond and Rodney, initially on the title insurance side, and then we looked at different ways of growing the organization as a whole, and out of that grew Sharestates. So we looked into the regulatory landscape. We looked at some of the other companies in the space, doing this crowdfunding concept for consumer debt, for business lending, et cetera. And we said, hey, this isn't really any different than real estate syndication. It's just online. And we use the term crowdfunding very loosely now, where technically it really just relates to Title III of the Jobs Act. Conceptually, you could look at crowdfunding as any form of grouping people together online to fund any sort of an investment. Some people earlier up here said, hey, you can look at modern day IPOs as crowdfunding. You're buying shares of different assets, different companies. So we set out, we started building our technology, got through all the regulatory and compliance issues, and ultimately launched the platform in beta mode of July of 2014, and then our full launch in February of 2015. So going through that process, we realized that we would have to pivot a couple of times. We are actually still a self-funded company to date, so all of our growth has been organic. We didn't go out and do the technology play with VCs and raising tens of millions of dollars. We did it the old-fashioned way, which was to build a profitable business that we could then turn around and reinvest those profits into growth. So for us, the last 2 years has been a really exciting process. We started with what was originally a Regulation A offering. We wanted to cater to the public markets, to non-accredited investors, because we grew up on the other side of the tracks and we never really had those opportunities growing up. We realized going through that process that in order to eventually reach the crowd, we needed to build legitimacy, not only in our business, but we needed to give the industry time to gain legitimacy in and of itself. So what we thought would be best would be to build a scalable platform that has traction, has an underlying core business and a track record. And to do that, we thought it would be much more productive to focus on a debt product which would return immediate dollars to our investors, but then also to focus on bringing on some institutional investors to help us scale. And true to our original goal, we do still plan on offering investments to non-accredited investors. And I think we're just getting to the point now where the industry has kind of caught up with itself. People are more knowledgeable about the space. The education curve has decreased slightly, although there's still a lot of work to be done. But we've built a platform that, thankfully has had traction. We've done about $500 million worth of loan originations over the last 2 years with zero loss of principal and a very minimal number of defaults. And we've tried to be as transparent with our process as we could. So one of the things we did in developing the business was to really look at what information do investors want to see? We looked at some of our competitors in the space and we saw, hey, great, they're posting, 5 projects, 10 projects, 20 projects a month, but there's very little transparency into how that loan was underwritten, how it was graded, how the rate that's ultimately charged to the borrower was determined. And I think we're at this point one of the few platforms that actually disclose that process. So if you go to our website, you'll see a risk matrix that'll identify 34 different variables that we look at in vetting a borrower, determining the price of a particular loan, and ultimately how that risk, how that return is adjusted for risk to our investors. So going back to 2014, for those of you who haven't really been closely following the real estate crowdfunding scene, when we first launched in this space, there were probably about 300 platforms. It seemed like every other week there was another company coming out. We'd see a press release. Some group got a technology team, slapped together a website, and I think somebody said it earlier, if you build it, they will come. We realized early on that definitely was not the case. There's a tremendous amount of work that goes into marketing these platforms, building up a following, finding investors, but also finding your origination channels. So one of the benefits that we had coming into this industry with our real estate background was that we had already built origination channels through our title insurance company, or through my partner's title insurance company, that gave us a leg up in starting the business. It gave us our core foundation that we could ultimately build off of. Today, I'd say there's probably about half a dozen platforms that actually have traction in the space. There are companies you guys may have heard of. There's Lending Home, which is primarily focused on a residential fix and flip market, primarily single family assets. They are probably the largest right now in terms of total origination volume. I believe they crossed $1 billion in originations sometime later in 2016. There is Realty Mogul and Fundrise, who are two of the earlier companies in the space. They are focused on various different endeavors. Fundrise has switched to an E-REIT model, so that concept of being able to pick and tailor your portfolio as an individual investor has kind of subsided for them, but they're still doing pretty well in their space. And Realty Mogul has taken a heavier focus on equity investments, as I understand it. The other two big companies in this space, if you guys aren't aware of, are Patch of Land, who's focused on a residential and multifamily product, primarily residential though, and Pure Street, who is not a little bit different than the other companies I just mentioned. They are not directly originating themselves, but they are buying loans and focusing strictly on the investor related aspects of this business. So for the rest of these platforms, we're really looking at two different things. We're looking at growing our origination volume side by side with our investors. Pure Street strictly focused on the investors. So just a little bit more information today, a little bit more information about us. One of the key differentiating factors of our platform is the diversification we try to provide to our investors. We have on average a larger transaction size. Our average loan's about $800,000 across the platform since inception. We fund loans anywhere from $100,000 up to $5 million, and that spans everything from residential to multifamily, mixed use, and true commercial assets like retail, office, hospitality, and even some raw land. And to date, we have investors coming to our platform, individual investors coming to our platform from about 30 states. So for our borrowers, coming from this industry and a real estate background, we realized that there was a pretty heavy emphasis on, less on the rate so much as the product we're offering and the service we're providing. Borrowers that are borrowing this type of capital are not coming to private lenders like us because they have poor credit scores or a lack of track record or experience. They're coming to platforms like ours and traditional hard money lenders because they have a unique opportunity. It's typically an off-market transaction where the asset itself won't qualify. So they're going in, they're making an all-cash offer with no mortgage contingency, and they have 30 days to close, sometimes 45 days at best. And ultimately what ends up happening is they can pick that asset up for below market value. It could be $100,000 or it could be hundreds of thousands of dollars below market value, and either convert that asset, rehab that asset, turn the units over, whatever it might take to get that asset bankable, and then eventually refinance the loans that we're providing them with bank-type financing. That's pretty much it. I mean, I don't want to run your ears off. Does anybody have any questions I can answer? Somebody's got to have a question.
Can I buy this in my existing brokerage account that my RIA manages?
We are not integrated with RIAs right now. So we've actually had a ton of those conversations. I think it was George earlier who said that they were actually just getting ready to integrate with an RIA. We are looking into how to do it. But typically what happens with these registered investment advisors is that they want to have direct oversight on the investments, whereas Our platform doesn't support that functionality right now for their reporting purposes. But as well as being a finance company, we are a technology company, so we are constantly adding new tools, one of which will eventually be targeted towards RIAs. We just have a few more. We have a 10-mile long technology list to build, so it's going to be a bit of a process, but we'll get there. Yes?
I stepped out for a minute. Did you say your minimum investment?
Our minimum investment's actually $1,000.
And can you accept it from an IRA, self-directed IRA?
Yes, we do take IRA investments.
What would the interest rate be?
So typically, we lend at interest rates between 9 and 13%. Historically, our platform investors have netted about 10.5% annually with monthly distributions.
What's the default rate?
Our default rate, so it depends on how you define default. Default for us is 90 days or more past due.
What percentage of the people who put in $1,000 would lose their principal?
None of them have lost principal to date. Yes.
Do the investors pick a particular project, or do you pool their money and diversify it into multiple projects?
It's completely project by project. So we offer a number of different tools. We've set up things like auto invest to make it as easy as possible for them. But you can actually individually pick project by project. Whenever a new deal goes up, there's a newsletter that goes out letting you know. Or if an investor chooses, they can set up auto invest, and they can be as general or as specific with that as they'd like. On the general side, you can pick from a risk grade from an A+ down to a D-, or you can get as detailed as you'd like with geographic preferences, loan-to-value ratios, minimum borrower credit scores, minimum borrower experience requirements, etc.
And it's like a term, you get your money back after a year or something?
Yeah, so on the residential side, what we do strategically is all of our paper is actually 12-month dated paper. Residential 1 to 4 family transactions usually have a run time of about 9 to 10 months. The larger transactions on the multifamily, mixed use, and commercial side will typically go about 18 months. But nonetheless, we start with a 12-month term, and then we actually provide an extension, or what we call a forbearance agreement, in month 12 as we see the extension approaching. We do that because it actually, in the forbearance agreement, this is more legal jargon, but it preserves our right to actually collect default interest as of the initial maturity date. So if the borrower were to default towards the end of their term, let's say in month 14 or 15, we can actually backdate to the default interest rate as of their initial 12-month term.
The investor has the option to continue after 12 months?
So that's the one thing about these types of projects. Because we're pooling together so many investors, the management ultimately comes down to us as a platform servicing the loan. But we have had investors come to us who, for one reason or another, are looking for liquidity. And historically, we've been able to, over the course of a week to 2 weeks, bring in a different investor to take their position over. Any other questions? All right. Thank you, everybody.